I'm going to reflect here on what happened last week with Scott Bessent. He's the head of Treasury. He's the chief financial officer of America. He's managing their money, and he's got this thing called the TGA, the Treasury's General Account. It's got about $1 trillion in there, which is about 1,000 billion. And that money comes from taxes, that money comes from borrowing money and having that there, and he uses that to manage the country's money, make sure things are flowing effectively, in his words. And last week, he said, now guys, we've already said we're going to buy $2 billion per month. They have 2 to 4 operations per month where what they do is they're buying bonds, debt, they're buying debt. Let's move over to Japan real quick. The yen is a really important currency in the world because they have a huge amount of debt. They've got a 250% debt to GDP, debt to growth, what they owe versus how they're growing. You need a lot of growth to pay for that debt. It's pretty much impossible. So they're kind of like this unicorn in the whole currencies of the world because they operate completely differently. I think France is in a really similar situation too. And then Germany is the opposite. Germany is like really have austerity. They have a really good way that they spend money. They're very fiscally responsible. The interesting thing about Japan is that they're the country that owns the most of America's debt. So America goes, hey, we want to borrow money and pay for stuff, pay for defense, pay for hospitals, pay for our elderly. So who wants to lend us money? Anybody? Lots of different places around the world who make a surplus, like China. They go, yep, we'll lend you some money. We made $1 trillion last year. We'll have all those bonds. We'll lend you money, but you've got to pay us, let's say at the moment, 5% per year, and that will make us confident that you can repay us. So in Japan owns $1 trillion of this debt, America's debt. Japan's having inflation. There's this thing called the yen carry trade, which is you borrow money in yen, you take out a loan in Japanese yen, and they had interest rates of 0% for like 20, 30 years. So you could borrow money in yen, which is basically free in their currency, and then you could buy anything that returned better than 0%, and you made that spread. You could buy growth, you could buy Bitcoin, you could buy stocks, or you could buy this debt, like this American debt. If the interest rate in America at the time was, say, 3%, you could borrow money for 0, make 3%, pay back your debt, and you made the spread. You made that money for free. But the problems happen when the Japanese currency starts changing, the American currency starts changing, and it gets really complicated. And this yen carry trade almost blew up a couple of years ago, and now it's put America in a really challenging position, and that is effectively why Scott Bessent has intervened. Because if Japan want to strengthen their currency because they have inflation, they've been raising interest rates, and their currency's been weakening. Usually when you raise interest rates, your currency strengthens because you're saying, we've got inflation, we're managing it, we're going to raise our interest rates. That's what's happening in Australia at the moment. You've got interest rates potentially going up another 25 basis points, which is just 0.25%. And the more Australia raises interest rates, the more our dollars will buy us in American dollars, especially if America is lowering their interest rates. There's more to it than that with the strength of the currency, but this is where the debt of Australia's debt of $1 trillion, America's debt of $40 trillion, this is where it all plays in together. Because if we don't trust the American government's ability to pay that back, the money that we lend them, then we have to demand a higher interest rate. Because if I think inflation in America is going to be 5% and the interest rate's 5%, that gives you a real interest rate of 0. So the real interest rate is the difference between inflation and the interest rate return that you get for money that you lend to someone else. So when you go and buy a house and the bank says you've got a 5% interest rate, if inflation is 3%, the bank's happy with that because they get a 2% spread on that money. And they're like, yeah, we'll lend you at 5%. We know inflation's 3%, so we know the real spread that we're making is 2%. We're happy with that. We're happy with that margin. And they print money. They create money for free anyway and lend it to you. So why wouldn't they do that? They're making money on nothing. Back to Japan. Their interest rate compared to America's, even though they're raising rates, is weakening. And it's weakening to the point that it's causing problems in this whole yen trade, in their entire economy too. And they're trying to manage their economy. Who are they going to look after when stuff gets hard? Are they going to go, oh, well, we're going to help the Americans out? No, they got to look after themselves. So the reason Scott Bessent intervened in these markets, in these so-called free markets, they always come out and they say, oh, we're doing this program, this TARP program, this QE program, this QE2 program, this yield curve control. We just need to make sure that the markets are flowing efficiently and effectively. And it's a bit of a wank because markets do flow efficiently if you let them. If you keep intervening in something, it can't be anti-fragile. You're manipulating it, and it sort of trends along up and down, up and down, up and down. But you've cuckolded it, and you've stopped it from doing what it naturally wants to do. And eventually, it drops off a cliff because the unthinkable happens because you caused it, you created it, you accelerated the problem by not letting the natural state of it play out on its own terms. Just like a business, for example. If you are a business and you're losing $10,000 each year, you're paying your staff, you're losing $10,000, and the government's like, no worries, like we'll come in and we'll lend you this 10 grand, you can pay us back later, don't worry about it, no interest, that's fine. Great, yeah, okay, I mean, my business gets to survive, I'll keep going. So you do that, and then you do that for 5 years in a row. The same thing's happening, you're losing money. Now, at the end of that 5 years, okay, things have changed in the economy. We want our 50 grand back that we've lent you over 5 years, 10 grand per year. Oh crap, I can't do that. You fall off a cliff because it was manipulated. It wasn't real. It wasn't attached to tangible real life stuff. And if something can't continue to go on forever, it won't. Back to Japan again for the fourth time lucky. In order to strengthen the Japanese currency, they need to sell the assets that they have and they'll buy back their own currency. That's what these countries do when they want to strengthen their currency. Now, what do they own? Well, they own US Treasuries. They might own some gold. They might own some. They might own the euro. They might own European debt. They might own Australian debt. But countries around the world sort of are all interlinked, and they all own pieces of each other's debt to diversify their risk, and it all stems back to America because they're the reserve-backed currency of the world. And America have to borrow money off other countries because people want American dollars to pay for stuff like oil. So they have this $40 trillion of debt is somewhat of an asset at times because it allows everyone to come back to them. But the problem is their growth isn't keeping up with their debt expansion. Their debt is outpacing their growth. If their debt was stable, it's not a problem. And America goes on continuing to have debt. You can have $20 trillion of debt. They could have $100 trillion of debt as long as they're making profit in other areas and they're able to pay for it. If they're making $20 trillion of profit per year and they've got $100 trillion of debt, it's not a problem. It doesn't matter. But the problem is when economic issues happen or when businesses start to struggle or when businesses fail and people lose jobs and the government has to bail people out and give people public jobs, pay for stuff so that the country can keep going on surviving and its citizenry continues to maintain a job and pay for a mortgage and have a house and want to be there. Otherwise, if they don't want to be there, they leave. And that's what happened in England after the First World War, and they left. They're like, we don't want to be here. And they took their gold, they took their assets, and they bailed, which means the country can't find its feet again. It can't survive, it can't thrive, particularly after the Second World War. And England was that strength in the West. It was all backed by the British pound sterling. And before World War I, 1914, the sterling was dominant. But then they manipulated it. They borrowed heaps of money. They had the First World War. They couldn't pay it back. The Second World War, there was a an unbalance between the First World War and the Second World War, the United States became the world's largest creditor, which means countries owed America money because America was growing and lots of people wanted to be there and discover the new land and get all these great opportunities. But America and England, the dollar and the sterling, they competed as reserve currencies between the First World War and the Second World War. And then after the Second World War, they had the Bretton Woods Agreement, and that's when the US dollar became, it would hold all the gold in America, and then America would back their currency to gold. And they said, we'll hold all the gold for you. You can have our currency. And if you exchange your currency between each other, that's as good as gold. You can redeem that gold if you want. You got $10 of US dollars, you can have $10 worth of gold. You just let us know. That's the history of it. And it's relevant because that's why and how America got into the position that they've gotten to, where they are still seen as the world reserve currency, even though in 1971, Richard Nixon he interrupted the gold TV show Bonanza, and he said, we are suspending the convertibility of the US dollar to gold, which was absolutely unbelievable at the time. To say that, hey, for 30 years, we've told you that you can have your gold back at any time. Now we're telling you can't. The French sent warships to America and said, give us our gold back. We're not leaving until you do. And that was after that happened, then Nixon made this announcement. And there's nothing more permanent than a temporary government program. So from that moment until now, 55 years, nothing has changed. It's still not convertible. Gold, the US dollar is still not convertible to gold. And what we value the American currency on, what we value the American dollar, and why it is the world reserve currency is because of its power and its military, is because of its debt that people around the world want to own, and supposedly the most powerful country in the world. But that obviously has been challenged recently by a lot of things that have happened geopolitically, with Ukraine in particular. When Ukraine was invaded by Russia, America went, oh, that money you lent us, that debt, those bonds, those treasuries. Well, since you did this naughty thing by invading Ukraine, we're going to confiscate your debt payments. We're not paying you anymore. That money you lent us, we're just going to keep it. And you can't have it back. You're kicked out of this system. And that really woke the world up to going, hang on a minute. Why would I own this government debt? Why would I lend the US government money if they can just kick me out of the system and never pay me back? Like, they showed their hand, and America showed their hand, and the world that challenges America are sort of waking up to that. And China's been very quiet, and they're just sort of sitting back and just watching things unfold because they don't need to do anything. They have just been buying gold hand over fist in the last decade. They realized this problem 15 years ago, 20 years ago, and that's when they started the Belt and Road Initiative, where they bought assets around the world. They did that because they wanted to diversify away from buying all American treasuries. And over time, they've still owned some, but they just sort of keep it there. They don't sell it. They just leave it there. And that's why you'll see that they own, the Port of Darwin, or a lease on it for 90 years. And they own the Panama Canal at one point. And they want assets so that they have a stronger, it makes them solvent. They own things. If there's trouble, they can sell things. If there's trouble, it's less likely to be because they have all these diversified assets. But nobody knows what China is doing with Bitcoin. They say they've banned it, but nobody really knows if they have it and if they own it and if they mine it. It's really challenging to know and trust China, what it says. So we don't they disclose how much gold they have. Whether that's true or not, nobody knows. Same as America. They say they've got $1 trillion of gold in Fort Knox and the US Fed. No one knows. It's just all hearsay. Donald Trump actually said he was going to go there and he was going to audit Fort Knox. He said that before he got elected. And then all of a sudden, I'm not going to do that anymore. Who knows why? Maybe the gold's not there. And he can't come out and show his hand to the rest of the world and say, hey guys, we don't have the gold. Like, the American dollar would die if that happened, or it would fall off a cliff. Something would happen. So maybe he's backtracked that one. fifth crack at getting back to the yen and why this is important and why Scott Bessent has intervened. And as you can see, it all adds up together in this amalgamation of all historical things that have happened and transpired they're all relevant to understand the full picture. If Japan needs to strengthen their currency because their population is struggling, they have an option. One of the options they can do is they can sell the US Treasuries. They can sell that money they lent to America. It's a bond. It's a 30-year bond, 10-year bond. Doesn't matter what it is. Doesn't matter the length of it. It's about the same. I think the 10-year is like 4.7%, and then the 30-year is like 5.2%, 5.3%. Doesn't matter. If they sell that, and they sell that into the open market, much like you would in any other asset, I want to sell it, I'm going to sell it to you guys. I list it on the exchange and I sell it, or I sell it to another country, I sell it to a pension fund. There's lots of people who buy this stuff. Pensioners need these bonds because it pays them an interest rate. When you don't want the volatility of owning Nvidia stock and Microsoft if your entire retirement wealth is going to drop 25, 50% because of something that happened in Iran, and then your retirement's wiped out. So you'll go, I'll have that, even though it doesn't get me growth, it only gets me 5% per year. I'll take it. I'll put $1 million into it. Then I get $50,000 per year to live on. And the end of that 30 years, I get the $1 million back. So you still own it and you get an interest repayment. That's why they do it. And that's why it's a reason why bond and debt is important. If they sell it, it makes the interest rate, the bond in America, it makes their interest rates go up. So if they go, you know what, we're going to sell 1/10. Japan says we're going to sell 1/10 of all this debt that we got, all these US Treasuries. There's not enough buyers. The supply and demand mechanics of the market interact, and the US debt, the US interest rate goes from 5.3% to 6%. Okay, so be it. That's a free market, right? Well, Scott Bessent doesn't want that because that causes lots of problems. When you have $40 trillion of debt and you go from paying 5% on that debt per year, which is, what's that? $2 trillion of interest per year, 5% of $40 trillion. That's how much interest they're paying per year. When that goes to 6%, now you're paying $2.4 trillion of interest per year. He can't have that because when interest rates rise, businesses that are operating day to day, they collapse too because you're renting the manufacturing plant or you own the manufacturing plant and your interest repayments increase. All of a sudden, your profit margin's wiped out. If you're making a 10% profit margin and interest rates go from 5% to 6%, you think, oh, that's all right. That's only, it's only a small change. That could put you into debt. That 10% margin could be wiped out and now you're making a 10% deficit. You're insolvent, you've got to sell it. People lose their jobs. Plus the debt explodes. Plus those people that were making money running the manufacturing plants, now they have to sell their business and they're not earning income and paying tax, which makes the American debt go even higher because people aren't earning an income to pay tax. So it's all interlinked in those ways. But what Scott Bessent did was, finally coming full circle, he said, we had this 30-year bond, the 5.3% Treasury. You can look at a graph, you can Google it, and it's going up. It's gone from 5% to 5.3% in a few months. And it doesn't seem like much, it's small movements, but these bonds are a third of the assets in the world. A third is equity, a third is bonds, which is debt, and then a third is houses and real estate. And Bessent said, well, I've got my stash, I'm the CFO of America. We'd already said a few months ago we were going to buy $2 billion of these bonds. People might come to us. We're going to buy it on the market with our savings that we've got. If they spend too much of it and interact too much and buy it, this is what they did in the global financial crisis. They printed money and bought bad assets. They went, the banks are going to, all these mortgages that people have that suck, that they're defaulting on, no private hedge fund, no pension fund around the world, no other government around the world want to own this stuff because it sucks and they've seen that there's a problem there. Well, the government will just buy it. We'll just buy it. We'll print the money. We'll figure it out later. And we'll just add that to our debt pile. We'll buy it. We'll give you banks a bailout. We'll give you the cash. You're not in trouble anymore. Now the US government will solve that later. And that's what they're saying. They're saying in this 5.3% US Treasury market for 30-year Treasuries, we will buy some of that. We'll buy $2 billion 2 to 4 times per month. Then they come out last week and he said, we're going to double our buybacks, $4 billion a couple of times per month. And these bond markets react to that stuff. So when he came out and made that announcement, they dropped a bit. They went from 5.3 to 5.2. But within a day, and also the yen, they had a deal where, this FEMA deal where the Japanese didn't sell that bond, that US Treasury, on the open market to places around the world. The governments just exchanged that together. But that money still has to come from somewhere. They swapped currencies to sort of diffuse it. But it's a signal that's saying something not right's going on. The government can't, it's intervening over there, and now it's doubling its buybacks. What's going on? And within 45 minutes, Bitcoin jumped like 10, 15%. Gold jumped from 4,000 to 4,800 in the last month because it can smell the smoke. And when there's smoke, there's fire. Something's not right. The yen gave back all its gains, and the 30-year Treasury gave back all its gains like the next day after they all did this. And then Scott Bessent went on TV again and he said, look, we've got $1 trillion here in our Treasury General account, our TGA, and if we need to intervene and solve this, we can. We have enough money to do buybacks to diffuse the problem. That is a massive signal. That's like, why are you intervening? It doesn't make sense. When we zoom in, like this stuff has happened all the time, and so we're kind of numb to it. But when you zoom out, you go, that's not normal. It shouldn't happen. And the bond market always sniffs it out. That's why it's been rising. Rates have been rising around the world. Things are getting hard. Because all the stuff that happened from COVID with free money flowed in, created all this inflation, it takes 4 or 5 years to play out. They tried to get ahead of it. They were too slow. They should have never printed the money anyway, besides the point. But that's the whole idea of Keynesianism and modern monetary theory, is that you can smooth out the bumps along the way. The government, the Treasury can intervene, solve a problem. If everyone's going to lose their job from COVID because we're all locked indoors, well, we either go into a depression and there's a huge problem, or we smooth that out by giving people free money. But this is what we're paying for it. But like, I'm losing it. I'm losing it because what they're doing is not normal. And it's obvious that what's going to happen. They're going to have to print money. They're going to have to manipulate, intervene, and solve the currency crisis around the world, because there's all these little spot fires popping up everywhere, left, right, and center. France has got a debt problem. Germany doesn't. Germany's next to France. They're like, what's going on here? You guys are being irresponsible. We're not. Like, they have that issue. Then you've got like demographic issues in England, where you've got like neo-Nazi parties rising up saying that they're going to troll the streets and they're taking back their country. You've got the demographic problem in Australia. You've got aging populations in Japan, in Australia, in America, where boomers are owed a lot of money from the governments because they've been putting money into these pension accounts, more so in America, and the government owes them like $200 trillion over the next 30 years. So who's going to pay for that? That money has to come from somewhere. The US government is now at a point where it's saying it's going to grow its way out. Okay, do you know what that means? Grow your way out of that $40 trillion debt means that you're going to have heaps more money coming in, which means you're going to have heaps more growth in what? In assets, which means what? Inflation. You have to have inflation for them to solve this problem. It's either that or austerity, where they go, cut all the spending. We're going to not fund defense. We're going to not fund all you boomers. Sorry, we're not. We know we said you've been paying into these pension accounts where we kind of lied. We tricked you. We said that you could have all this free stuff, but you can't anymore. Or you print the money and in assets go through the roof. 2 options. Now, are they going to cut defense spending and then no longer be able to defend themselves? America's got a lot of enemies. If they cut defense spending, even the signal of that is like Places around the world are going to attack them for all the things that they have done, where they've gone into all these countries in Asia and South America, overthrown leaders and taken the country's resources. In Afghanistan, in 9/11, they went in there, they kicked Russia out, they funded Al-Qaeda as like the mercenary group to kick Russia out, and then they promised Al-Qaeda that, they'd help the country. They didn't. And Al-Qaeda created September 11. Now they're doing the same thing in Iran. They're like talking about bombing and destroying citizen infrastructure, which is a war crime. So if you do this stuff and then stand up there on TV and say, we are protecting the free world, there's another side of that where kids, families, women, just the general population in Iran are like, you destroyed our entire country. You blew everything up and I feared for my life. And they're like, well, it inspires violence and terrorism. So is America going to stop their funding their defense programs? I wouldn't have thought so. Are you going to really throw the boomers out of the bath and throw all their toys out and say, sorry, you can't play anymore? I don't see it. So the only solution left is to print money, do all these manipulations, say these words, create these programs like TARP and QE and yield curve control, and say that you're creating a safe exchange and you're just making sure markets are flowing freely and you're just lubricating the wheels of free markets, and then you're really intervening and manipulating and trying to put out spot fires and putting your fingers in holes in the boat that are starting to leak. And at some point, the pressure builds, you either run out of fingers and toes or you get a blowout in the side of the boat and the water comes gushing. And that doesn't necessarily mean a stock market crash. It will, because people get scared and they sell what they have, not what they want to sell. So when that happens, when a big problem happens, like the global financial crisis or COVID or the bond market collapse in 2019, where there's no bidders for these treasuries, there's no bidders for this debt, when those black swan events that you can't predict happen, people sell their assets and they go into cash. People sell their bonds and they go into cash. People sell their Bitcoin, their gold, and they go into cash. But the first thing to bounce off that is Bitcoin and gold. So if something bad happens and Bitcoin drops 10% because of a financial issue, it'll be the first thing to shoot back up. But these governments are just out of touch with reality. It's sickening. I was reading about Switzerland. Final thought. Switzerland doesn't have a government in the sense that it has small municipalities. And everywhere around the world, you've got these big governments getting bigger and bigger and bigger, and more people depending upon them. In Australia, if you've got largely public servants, support workers, nurses, doctors, police officers, teachers, infrastructure people that are paid for by government, they're all incentivized to support government because their job and their livelihood depends upon it. And that's the problem. Governments are too big. Those relying upon governments are too big. Switzerland, no government. Safest, best place in the world. They're just so out of touch with reality.